Same job, same paycheck, two completely different economies. In America, your credit score is your price tag. And the weird part? It doesn't measure how rich you are. It measures how predictable you are. Here's the open loop. The most responsible move you can make on paper can still drop your score. Not because you did something wrong in real life, but because the scoring system is watching a different game than you think. In the next few minutes, I'm going to show you what that game actually is. Why your score spikes and crashes, what lenders see when they look at you, and the practical rules that move it the fastest without playing dumb tricks. Let's start by killing the biggest myth. Your credit score is not a moral grade. It's not good person points. It's not a badge of honor. It's pricing risk. Think of it like a thermostat. The thermostat doesn't create heat. It reacts to signals. The credit score doesn't create trust. It reacts to signals. Your balances, your history, your timing, your patterns. And lenders love this because they don't have time to know you. In a modern credit market, they're not reading your life story. They're buying a shortcut, a standardized prediction of how likely is this person to pay late. That shortcut becomes your cost of money. That's why the score matters more than people want to admit. It quietly decides your APR on a credit card, your auto loan rate, whether you get approved for a mortgage, sometimes even whether your deposit is higher for utilities or insurance pricing gets uglier. And when rates rise, the score becomes even more powerful because lenders get pickier and pricing spreads widen. Same borrower on the surface, different bucket in the system, different APR. You don't just borrow money, you borrow trust, and your score is the receipt. So what is the score mechanically? It's 5 dials. If you understand the dials, you stop guessing. If you don't, you end up doing responsible things that feel right and still get punished by the algorithm. Here are the 5 dials. Dial #. Payment history. This one is the heavyweight. Late payments are like permanent ink. A single 30-day late can outweigh a year of perfect behavior. Because the model isn't asking, are you trying? It's asking, did you break the contract? One late mark signals the one thing lenders fear most: unpredictability at the worst moment. That's why payment history is treated like a scar. It fades slowly. Dial #2. Utilization. This is the dial that confuses almost everyone, because it feels like the score should reward you for being responsible with debt. But utilization isn't about debt as a life philosophy. It's about how much of your available credit you're using right now. If your limit is $10,000 and you're sitting at $7,000, the system reads high pressure. Even if you always pay on time, it's not judging your character, it's measuring strain. Joke version, because this is the simplest way to remember it. Utilization is like walking into a restaurant and yelling, "Relax guys, I'm probably paying." Technically true, but everyone grips the register tighter. Dial #3. Length of history. The system loves boring. Older accounts mean more data. More data means you're easier to predict. Your score isn't impressed by a fresh start. It's impressed by a long, uneventful track record. This is why closing your oldest accounts, especially no-fee ones, can sometimes shrink your story. You didn't become riskier in real life, but your data window got shorter. Dial #4. New credit and inquiries. Too many applications too quickly looks like distress. The model can't read your intentions. It just sees frequency. A bunch of new accounts in a short time can signal, "I need money now." That doesn't mean you should fear applying for credit. It means you should stop applying in a chaotic way. Dial sync. Credit mix. Dial sync. Credit mix. Cards, auto loans, mortgages, student loans, different types show you can handle different contracts. This dial is smaller than the first two, but it's real. Now, here's the key line. Your score isn't one number. It's 5 arguments happening at once, and you only hear the final verdict. So if you've ever asked, why did my score drop? The answer is usually, one dial moved faster than the others. And that brings us to the most underrated part of credit scoring, the timeline. Because the system is not real time, this is where people feel like they're being gaslit. You do the right thing today, and your score doesn't move. Or it moves the wrong direction. Here's why. Most lenders report to the bureaus about once a month, often at your statement close date. That means your score is reacting to a snapshot, what was reported, rather than your day-to-day intent. So 2 people with the same spending can look totally different to the scoring system, based purely on timing. If you pay down your card before the statement closes, the reported utilization is low. If you pay it down after the statement closes, even if you pay in full, the system may still capture a high balance for that month. And utilization is the dial that can swing fast. Here's the core mechanic in one sentence. Utilization can move your score in weeks. Payment history and age move your score in months and years. This is why someone can do everything right and still look stressed to the algorithm for a cycle. New metaphor. Because it's accurate. Your score is a monthly screenshot, not a documentary. You can have a great life and a bad screenshot. So if you're about to apply for a mortgage or refinance, the fastest lever isn't opening a new card or doing some complicated dance. The fastest lever is controlling what reports. And now we have enough machinery to bust the myths that cost people real money. Rapid fire. Myth has shown. Carrying a balance helps your score. No. Paying interest is not a cheat code. The score doesn't reward you for suffering. What helps is on-time payments and low utilization reporting. You can do that while paying in full. The system cares what balance gets reported, not whether you paid interest to prove loyalty. Myth #2. Checking your own score hurts it. Usually no. Checking your own score is typically a soft inquiry. It's like stepping on a scale. The scale doesn't gain weight because you looked at it. Myth #3. Closing cards is always good. Sometimes it is, especially if fees are dumb or the card tempts you into bad behavior. But mechanically, closing a card can reduce your total available credit, which can raise utilization. And it can reduce your average age, so your score can dip even though your finances improved. That's not unfair. That's the model responding to less available data and higher measured strain. Myth #4. You need to be rich to have a high score. No, high score doesn't equal wealthy. High score equals consistent. The system isn't asking, how much money do you have? It's asking, how reliably do you behave under pressure? Now, if you want practical rules, real rules, not forum superstition, here are the ones that actually work. Rule A. Never miss a payment. If you take nothing else from this video, don't get a late mark. Automate minimum payments as a safety net. You can manually pay the full balance later, but the minimum auto pay is your seatbelt. Because late marks are nuclear, everything else is strategy. This is survival. Rule B. If you want a quick boost, manage what reports. Pay balances down before statement close, not just before the due date. This is the responsible move that feels weird. People think, I pay on time, so I'm good. But the score is watching the snapshot at statement close. If you want the system to see low utilization, you have to time the paydown. Rule C. Don't spam applications. If you're rate shopping for an auto loan or a mortgage, do it in a tight window. The system often treats clustered rate shopping as one event when it's clearly the same purpose. But if you spread it out and apply randomly, you'll look like someone collecting credit out of desperation instead of comparing rates. Rule D. Keep old no-fee accounts open if they're not a risk to you. Age is leverage. Old accounts provide long-term stability signals. If you have an old, no-fee card that you can keep without using recklessly, it often helps more than it hurts. Rule E. Rebuilding is boring on purpose. One starter card, low utilization, perfect payments, time. The system loves boring. And now the second joke, because it captures how absurd this all feels. Credit scoring is like a clingy ex. It says, I'm over you, then reacts to one late text for the next 7 years. That's why people who mess up once can feel punished for ages. Because the model is built to fear repeated behavior, and late marks correlate strongly with future late marks. Now, let's zoom out because this channel isn't about hacks. It's about understanding the system mechanics. Why is this the hidden operating system of the middle class? Because credit scores change your cost of living without changing sticker prices. A grocery cart can cost the same today as it did yesterday, but your monthly budget can still get crushed because your APR is higher. Your insurance terms are worse. Your refinance options disappear. Your ability to smooth shocks, car repair, medical bill, job gap, depends on whether the system prices you as stable or stressed. When borrowing gets expensive credit cards, auto loans, mortgages, the score becomes a gate. It decides who can absorb a shock and keep moving, and who gets trapped in expensive debt with no exits. That's one reason the middle class feels like it's running uphill when rates rise. Not politics, mechanics. So what should you do with all of this? Here's the clean recap. Your score is a risk price built from 5 dials. Payment history is heavy and slow. Utilization is fast and sensitive. Account age builds stability over time. New credit signals intensity. Mix adds a small boost. And the timeline matters because the system is reacting to what reports monthly, not what you meant to do. If you can keep payments perfect, keep utilization low at reporting time, and avoid frantic application behavior, you've already beaten 90% of the chaos. Now, if you want the next step, the macro step, the video after this connects credit scores to the bigger machine. How banks create money as loans, why debt sticks even after the economy recovers, and why interest rates change your life before they change the headlines. If this helped, subscribe. Not for hype, for clarity. Because once the system makes sense, your decisions stop being guesses and start being moves.